Welcome to the REI Diamonds Show with Dan Breslin, your source for real estate investment jewels of wisdom.
Welcome to the REI Diamond Show. I'm your host, Dan Breslin, and this is episode 137 with Lane Kawaoka on scaling up to 2,600 units in multifamily. Lane is a returning guest of the REI Diamond Show. He came on in April 2018. Since then, he's added more than 1,400 units to his portfolio. We discuss also the topic of first-year bonus depreciation in this episode, a gift from the new tax code for high-income individuals who are interested in passive losses, and strong investment returns. Plus, we have an in-depth discussion on managing property managers, a little discussed yet valuable skill. Let's jump right in. All right, Mr. Lane Kawaoka, welcome back to the REI Diamond Show. How you doing today?
Hey, thanks for having me back.
Cool. So we are in, for everybody who's listening later in posterity's sake, we are in August of 2019. We've seen a lot of interesting things going on in the marketplace with the interest rates. I am enjoying the middle of the summer here in Chicago. It's a great time of year to be in Chicago. Whereabouts are you recording from today, Lane?
Honolulu, Hawaii.
Nice. It's always a good time of year then there, huh?
It's a little hotter than normal, but hey, not complaining.
Nice, cool. So we have done an episode previously, Multifamily Investor. I'm going to link to that episode in the show notes. So if anyone kind of wants the full background story about Lane, the listeners who come in every week and remember Lane, we're not going to spend a lot of time on that. But you were here April 2018. Do you want to talk about how your business has grown, how your investments have maybe changed, or anything else that's happened that's been big in the last year and a half or so, Lane?
Yeah, I think you did the math for me. There's I picked up another 1,400 units, several apartment buildings. We do syndications, and we bring in investors, and we go after bigger deals, usually about 100 to 200 unit properties. But the more importantly, the bigger thing is like I quit my job 5 months ago, and
congratulations.
Yeah. It was it's hard, when you make an easy $100,000 a year for doing barely anything. I'd say a couple hours of work every day. It's hard to leave that gravy train, but it was the right thing to do.
That's fair. And if I remember correctly, that was as like project manager, engineer. It had something to do with construction, right, Lane?
Right. I mean, it was a pretty nice gig. I mean, it was in the public sector. Pretty nice people to work with, but I just couldn't handle just putting on clothes and going to work and commuting. And just really, just a lot of lost time, Those few hours are so precious.
Yeah, I totally agree. I work from the office at my home office 90% of the time. And when I have to travel, it's like very grating on my nerves to take, 25, 35, 45 minutes to get to face-to-face meetings when they're in Chicago, or basically an entire day when I have to travel to one of the other markets that we invest in. It's very, very taxing to productivity. So I totally understand. So you're buying multifamily. Do these larger 100, 200 unit projects, are you buying like completely stabilized assets just with low rents, or is there usually a CapEx capital improvement plan involved in your strategy? Because I think it's more of a value add, and you're definitely going to raise rents and count on those things over time in order to add value, right?
Right. I mean, my strategy is mostly stabilized, 90% occupied or more, so we can get that Fannie Mae non-recourse debt. That's a lot safer than a lot of these bridge loans out there. And especially, like you mentioned, all the signs of the economy are showing that, this nice 12, 15-year bull run might be coming to an end. So in that respect, I'm going to keep investing for sure, but just make sure I focus more on cash flow and stabilize buildings already.
Gotcha. Yeah, the reason I asked is I wondered how important. I recently bought a 10-unit building, and then I recently found out that the roof was bad on that 10-unit building. I didn't raise money. I prefer when I'm dealing with my rental properties. I prefer to personally own them. That way I'm the one at risk. So although I don't right now scale into the larger deals that you're involved in and doing at this point, I have two separate pieces of my business. So we're flipping houses and we've got millions of dollars from private individuals, high net worth individuals, and we're paying, 10%, 2 points. And I like those deals, Lane, because there's kind of an ending date. So in some of those deals, when I raise money from investors, we buy it, we sell it, and we pay them back in 90 days, 120 days, or maybe we do construction on that project, and maybe it's like a 6 or an 8 month payback. Or if we, missed something in construction, or we had problems with contractors, or the property takes longer to sell than we anticipated. Sometimes the projects go on for 10 to 12 months, or even a little longer on one or two of them. But I like the fact that I have a little bit of this like end date scheduled with my investors, and they can go on and choose to do something else with the capital. They kind of have some freedom with the capital that they invest with me, and I find that that's why a lot of people invest, and I kind of like the thought of that and not being committed long term. So I invest in my long term stuff with money that out of my own savings. So anyway, I get this 10-unit building, and then the roof's bad, and then I get the bid, and this is a seller who told me, as I'm sure you probably heard, similar as everyone in real estate. Yeah, the roof was done. Last year the roof was done. I think, okay, great. And, I made the mistake of not having a roofer go and evaluate it, but I got a good deal on it. I still am way profitable on this deal, even with the $39,000 roof estimate if I end up having to pay that cost to replace the wood and do the roof, etc. And I'm thinking to myself, the thought that crossed my mind, because I've made offers on a couple of, $8, $10, $12 million projects in the last 6 months. And the thought that crossed my mind is, man, if this was, a 125 unit building with a flat roof as opposed to 10, it would probably be closer to 600 square of roofing instead of the 60 I have. And man, that could be a $200,000 or $300,000 roof. I don't know what my comfort level is looking at budgets of larger construction, and so I'm hesitant to take that risk personally. And I'm curious if you have the self-awareness and would shed light. Do you think that managing those public sector construction projects in the, multi-million, tens of millions, I don't know the size, but much larger than my $80,000 rehabs, did that provide maybe some perspective on the risks that you might be taking when you're buying a 100, 200 unit, I don't know, $3 to $10 million project, Lane?
Yeah. I mean, in the public sector or even private sector, when you're working for a JOB, those jobs are created for. You don't need to be a standout player. You don't need to be a freaking genius to do those jobs. It's a lot bigger numbers, and that's what I like about apartments. I think in your situation, you're gonna have to kind of finagle and get around it, and whereas apartments, it's add another 2 zeros. It sounds more intimidating, but it actually is more institutional. We can go back and we can fight and we can sue and get that money, as opposed to like a smaller, in residential world, 1 to 10 units. Sellers are doing that all the time, and you can't really. There's no recourse against them. But when you're coming after these guys for $200,000, $1 million roof, or something that they left out of the contract, now we can go back and get it. So it's kind of like one of the misnomers, I think, with apartments. It actually gets easier as you get your way closer to the mountaintop.
Gotcha. And one of the things I want to circle back to it that you mentioned was that you are going after these stabilized buildings, 90% occupancy plus, with non-recourse Fannie Mae financing. Now, I assume this is safer, and I think I know the answer to why it's safer, but can you shed some light on that for us here on the audience?
Yeah, so just kind of going over difference between recourse and non-recourse debt. So recourse debt is what we're all pretty much familiar. This is what we buy our house with, even though we get a Fannie Mae, Freddie Mac loan. 2008, the values go down, we're underwater. You are liable for that remaining balance. And even though that they couldn't really collect it, the banks are going to come after it. So unlike those, non-recourse debt is we put down the down payment for the apartment building, but if the apartment fails, and as long as there's no wrongdoing like embezzlement or stealing or, falsifying records, we as a partnership group can just walk away. And yeah, we lose our down payment, but they don't come after us for the $5-10 million loan. So it's a nice little peace of mind for the general partners who are typically signing the loan. The limited partners are just one more step removed. I don't think you even care either way. But for us in the general partnership, it's a big deal.
Yeah, I mean, if you had one building that, took a humongous dive in one specific market and you had 6 other buildings that were stable and surviving because maybe the marketplaces did not change as dramatically or drastically as that one underperforming asset, the risk becomes that if it were recourse, the general partner could potentially have jeopardized the other remaining pieces, the other 8 pieces of that, that portfolio by having that one portfolio piece that went down in value tremendously, as opposed to non-recourse where the other properties would not be at risk. Did I get that right?
Yeah, I think you have the right idea, except, we put each individual property in its own LLC. So, all our deals are sort of firewalled. If one goes down, well, the other 12 aren't touched.
Gotcha. Do you know whether or not that if they were recourse loans, whether the bank could cause legal problems for the rest of the asset?
Oh, yeah. Right. Because what happens is when, the loan is getting assigned, you need to have key principals or KPs or loan guarantors sign up to be the fall guy for that loan. So these guys, they need to have a net worth and liquidity greater than or equal to the loan in their bank account. And they're going to need to show a roster of all their assets. And should that doomsday event comes in a recourse event, then those assets are totally feasible by the banks.
Gotcha. And in that instance,
right, in that, banks don't care if you've got them in different LLCs in terms of recourse debt.
So if a loan goes bad, the bank is filing suit. They're going after bank accounts, properties. They're going after everything in the name of that guarantor. And if that guarantor happened to sign on 1, 2, 3, 5, 10 deals, this would be something that if I were going to invest in an apartment building deal, this is a very large place where there could be unknown risk for me as the market does potentially change. If a guarantor on a loan of the project that I'm investing in ran around and signed off on, 5, 10, 15, 20 other projects where he was recourse for the loan. Is that correct?
Right. Just hopefully you're not in the deal that suffers. But
yeah, if one of the other deals suffers and all of a sudden the banks come in to take everything else, are they able to come after his other assets, and cause problems for the surviving deals?
They likely can take away his position, but I'm going to have to talk to a lawyer on that one. But I'm thinking that everybody else owns their own share, and they're not going to come and take away everybody's other assets. But that's the reason why we like to play around in the non-recourse loans. So all this sort of just goes away.
And
but
so
now when you're
you're
seeing people going after these 50% occupied buildings with bridge debt, this is all the stuff that's involved, all these conversations.
Gotcha. So stabilized non-recourse, what are the down payment requirements and what's the interest rate? Is this a fixed rate or does this adjust over the course of time when you have these Fannie Mae loans?
Yeah, unlike residential loans, it's very simple, 30 years, fixed rate. Commercial loans are a little bit more, actually I would say if it's new to you, it's a lot more different. There's a lot more variables. Most times we're getting debt that is amortized over 25, 30 years. And typically we're going in with a 20% down payment. Now, where things get very confusing is, you have different loan terms, right? Some of the more fixed rate terms range from anywhere from 7 to 12 years. Obviously, you like to have a longer loan term. I like to look for loan terms that are about at least 8. But ideally 10 or 12 years. And then also you've got different hybrid loans where, the downside of those fixed notes are that you have loan prepayment penalties. So if you do a good job and you reposition the property and you increase that NOI and you sort of double everybody's money, you want to sell. but you're going to have to pay this big prepayment penalty. So there's some other hybrid loans out there that sort of, kind of take that away, but they're a little more costly on the front end and a little bit, they are a little bit lower interest rate too. So it's a world of lending. You rely on your lending broker and you kind of talk about what's your strategy, which way you're leaning in towards, where the property is going, and you try and pick the best fund for your situation.
So one of the things that jumps to mind is it sounds like you're a bit of a conservative investor. If you're sticking to these stabilized properties, it's a little less risk in my point of view than doing construction and renovating and then renting, 50% occupancy up to the 90. So you buy something that's a little more stable, maybe a little less effort, using these non-recourse loans. What else about your style, if I'm correct in the assumption that you would say you're conservative, would you say to maybe me, if I were going to lend money on one of your deals, that would make me realize how conservative you are in your approach?
Yeah, so we don't take in private money lender. All our investors are equity investors, so they get the upside and the depreciation. But, another aspect that we look at is, from a cash flow basis. Yeah, there might be 80 units or 150 units, but when you break it down on a per unit basis, we're typically buying properties at under $50,000 a unit that rent for about $600 to $700 a month. So right there, it checks the box for the rent to value ratio. Ideally, you're looking for something 1.5 rent to value ratio or higher. And 90% occupied, like we said, but, from a per unit basis, what I like to look for is that property that if the tenant moved out and we just rented it up without rehabbing or anything, we would probably increase those rents from maybe $600 to $650 right off the bat. So it's automatically low-hanging fruit value right there. And then we come in with a $4,000 to $6,000 rehab package, and we bump those rents up an additional $50 to $100. And that's it. That's our business plan. We like to call it a slow flip, but it's also a hybrid because we're getting cash flow in the meantime.
And is the $6,000 renovation package, is that like a CapEx that's funded up front, or is that funded from rents and operations?
Yeah, so we raise the CapEx, and we also raise cash reserves, just in case, things don't go well in the first few months. The first few months are always a little bit shaky. Occupancy will typically drop from 90% down to maybe 80, 70%. But then after the first quarter or two, we start to come back up and restabilize.
And why is that, Lane? Why does it drop?
Well, one of the first things we're trying to do is clean out house, right? Inevitably, a seller is always going to try and pull a fast one, like as you mentioned. They're always trying to fill up the property with warm bodies so that we can buy it at 90% and above, so we can qualify for that Fannie Mae, Freddie Mac non-recourse debt. And, that's just a smart business thing to do. They're not owning the property. They don't have any long-term, outcome into it. So we understand that, and that's just the name of the game. And what we do when we take over is we tell everybody, hey, there's a new sheriff in town. We're going to fix everything. We're going to make new improvements in here. But look, if you can't afford the $100 rent increases for the additional value that we're putting into these units, you got to go, man. So that will usually clean up house with a lot of bad characters is what we're trying to do. And then we also try to, we're also kind of getting the message out, hey, rents are going to go up 5 to 15%. And that usually will take out a few more people. And especially in the beginning, we're aggressively trying to rehab those units to get those higher rents right off the bat and doing some exterior changes. So a lot of things are going on in the first 3 to 9 months. It's akin to tearing off the Band-Aid quickly. Do you tear it off slowly, or do you tear it off quickly? You would think you want to tear it off quickly, but you don't want to tear it off too quickly that now your cash flow goes in the red. So there's a very fine balance in here. How quickly do you do it so that you're, at the end of the day, our investors want to hit that top line, returns at the end of the business plan of 5 years, but they also want cash flow. So there's kind of two not quite mutually exclusive goals that we're trying to hit here.
That makes sense. So are these, shady characters or however it was described, are these typically at the end of their lease on a month-to-month lease? Like, what are the actual notifications looking like? Are you knocking on the door and filling them in? Hey, the rents are going to go up. Or are you sending a letter to all residents? I mean, what's the actual process for that ripping off of the Band-Aid when it comes to removing and shuffling through the tenants, evictions, et cetera?
Yeah, it could be a variety of ways based on the community, Class B or C or where it is regionally. But it can be, they already know when a new owner is in town. People know. They live there. And then, sometimes we'll post postings, hey, or we'll send out individual letters or send out emails not to investors, but to tenants saying, hey, this is what's coming down the pipeline. This is a picture of our new upgraded units that we're going to put in, and yeah, rents are going to be going up. And what we're trying to do also we'll try and seek out those bad characters and put a little bit of pressure on them to get them out too. Every property is a little bit different. And I'll be honest with you, Dan, I don't know, man. I'm an apartment investor. I don't get involved in the day-to-day nitty-gritty. I have property managers that do that dirty work for me.
Gotcha. Makes sense. So do I. And I've found that there's a certain skill level that I've developed in managing my property manager over the course of time. It's definitely, I've heard people say, like, you need to manage your own rentals, face to face or on your own. This is like early advice when someone's getting into real estate. Manage the first one so that way if your property manager is doing it the right way. And then I've found that second tier of advice of like, wow, there's a lot of KPIs and metrics and things and ideas that I could change, tweak. Hey, is this getting handled? Things that I'm paying attention to on behalf of or with my property manager, where I don't find it to be a totally hands-off process. But if I pay a little attention to it, I can help steer it that my small portfolio that I have performs better over time. Have you noticed the same thing? I thought you kind of laughed when I said it, but maybe there's a couple little light bulb moments you've had with managing your property manager.
Yeah, I mean, we start off with a property manager, but, based out of just off the top of my head of the 12, the 14 buildings we've got, I would say half of them we fired in the first quarter because they just weren't hitting our metrics. And that's the nice thing about apartments. You have 100 to 200 units. Numbers are going to show the inconsistencies, and it's going to show poor performance. There are such a key statistics that you can monitor to keep your property manager accountable. And what's nice about buying apartments is, unlike single family homes, is when we go and buy apartment, that property manager is doing our physical due diligence with us. And at the same time, they're submitting to us a profit and loss statement that we're going to be holding them accountable to. So it's sort of like they're proposing on a project to hit these numbers. And when they don't hit them, now that's an opportunity for us to retrade a contract with them or just outright fire them.
Did you inherit those property managers with those buildings or select them on the way in on the ones that you've had to end up firing?
Most times we will get our new property manager management firm in. And these firms will typically manage anywhere from 500 to a few thousand units. But they may absorb the key staff. And that's always kind of a sad thing. When we go and visit these properties, these property managers in the office, they're all great people. They have a lot of rapport with the community already. And so we try to absorb them, or at least, we're the owners of the property, which we don't really have any say, but we kind of urge our property managers to absorb these key personnel. It's just sort of the right thing to do.
Yeah, and I think there's also a benefit because a lot of times the on-site, property maintenance guy or the woman or guy sitting in the office renting the units knows the stories about the tenants in there, a good chunk of them, knows the stories about, the drain lines that cause issues down at the south end of the lower end of the building, know about just whatever kind of finicky little things that you would have to be present on a property for 1, 2, 3, 5 years in order to know. And if you just quickly get rid of them, now you don't know about some of the nuance of the property or the tenant population, right?
You're exactly right. The other side of that coin that I've seen too is, that property manager gets a little too buddy with those people over the years. I remember I visited one of my properties and the property manager's sister was there just hanging out. It was a very kind of lax environment, and that was another one that we fired. Look, I'm all good with a lax environment where everybody's friends and singing kumbaya, but when you're not hitting your occupancy numbers, now that's when I'm going to start digging in. So we got like a leasing specialist in, and if anybody's ever used these guys, they'll charge you like 100% of the first month's rent. That's sort of the bounty for filling up your property. But they are amazing. So they went from like 70% up to almost 100% pre-lease in a matter of a few weeks. And when we asked the property manager, like, all right, well, what did you think? Did you learn anything from these guys who sat in your desk for a couple of weeks? They said, no, we would have done it, but we're just too busy. Well, we fired them, and now they're not that busy anymore. But, that's just kind of the stuff that happens. I mean, it's the numbers drive the actions.
So is the leasing specialist a different organization, company, or group of people or individuals than the property management firm who you would eventually have collecting the rents and, doing the maintenance and things of that nature?
Right. They're what you do when you get into trouble. Think of it like a headhunter for a company. HR is supposed to go and find good talent, but, sometimes you need that external consultant. And that's what's nice for apartments. They're much on a larger scale. So you have the funds to pay this stuff. Like, we were talking about that roof example. One of our buildings burned down because of a crazy tenant. And, now we're fighting against insurance, trying to get that paid out in claims. So what do? Well, we just hire a consultant to fight on our behalf, and it's well worth it. Whereas a single family home or, then a 16 unit, you don't have the funds to do that. So that's where the economies of scale really help you out. And it makes my job a lot easier,
So what are the KPIs that you watch? If you could say, here's the 1, 2, 3, 7, however many there are, what are the KPIs that you're watching on your portfolio to know whether or not the building or the management is performing as it should?
So the first one is, your top line income and your expenses. That's what drives your NOI, right? You're trying to overall increase your income and lower your expenses. So there's obviously a few things you got to look out for, like income, for example. Are you having a lot of people who aren't paying, but they're physically there? This is the difference between physical occupancy and economic occupancy. Because you might be 100% full, but if only 80% of them are paying, then you've got 20% economic vacancy, and that's what you need to focus on. And you might need a hammer or a gun to go collect that. Saying that half joking, but that's the action you do when the numbers show you that. Expenses could go up. It might just be somebody who's letting the water run a little bit too long. So in a lot of these buildings, you'll have water meters, and you'll be able to sort of isolate, where is money going down the drain, literally. So other KPIs from a high level is, what is our occupancy and what is our pre-leasing numbers at? Because that's ultimately going to drive the income, right? People may or may not pay after that, like we said, but that's kind of the beginning of the funnel. Other KPIs that I'll look at is, from a business perspective, we're in a 5-year business plan here to infuse a little bit of capital, put lipstick on a pig, and bump those rents up $100, $150, 10 or 15%. That's what I'm looking at. What are the rehab units absorbing for? Are we hitting our performer rents? And what are our make-readies or our non-rehab units that we're just kind of doing a quick shuffle on moving people, and what are we getting for those? That's ultimately where the ship is heading. Whereas the occupancy numbers, that's really what our cash flow today is getting. So again, there's two goals here.
Can you define the pre-leasing KPI? What exactly does that number represent?
Right. So that's like sign-ups for move-ins in the next month. So those are people you've got kind of on the docket that are qualified and ready to move in.
And have signed a lease, or is this just like leads that are in the system?
Well, qualified leads.
Qualified. So they've applied?
Right. Applied, and they meet all the criteria, such as 1/3 income is the rent. No big issues in terms of criminal reports. Good quality tenants.
Gotcha. So the property manager that's then going to be on site, just like operating this after the, say, leasing specialist is through, don't they also typically take that first month rent, or is that just something that I'm dealing with in my, 10, 15 unit size portfolio?
Yeah, I mean, when you get to the more commercial property management firms, typically they are going down to about 5 or 6% a month of the income. And they are not really charging a lease-up fee, but sometimes they'll also do a payroll line item. So you're actually paying the salaries for these guys. So that's the nice thing about these larger buildings, is that you're getting full-time staff. Your property manager's not running your stuff and then 18 other people's properties. When you get above economies of scale of 60 units, now you're able to have that property manager, but in the seat, in the property, they're doing it all the time. And that's one of the, the struggles is like, are they really doing stuff all the time for our property? But, when you get above 100, 200 units, there's just so much work. There's really no way that property manager is kind of commingling work with other properties. And then when you get above 100 units, now that's when you're starting to have that full-time maintenance worker who's out there all day long. And those two can kind of work. The property manager can be doing the leasing, and then they can be assigning work orders to that full-time maintenance staff. And you're not having to pay third-party costs, the upcharges of getting a one-day contractor out there to do this. This person's in-house.
Yeah, it's interesting. So it's a payroll line item in addition to the 5 and 6% fee. I mean, am I paying $60,000 a year for, an office person and assistant plus 5 or 6%?
Right. Yes and no. I mean, depending what the size, and of course negotiation, right? But if you're paying somebody 50, 60 grand a year after, on 100, 200 unit property, I mean, just think how much revenue you're generating from that. I mean, that's a drop in the bucket.
That makes sense, yeah. And it beats out, I mean, if they're releasing, I don't know how many turnover, if the turnover rate's a year, 2 years, 3 years. I mean, if they're releasing 30 properties at $600 a month, yeah, I guess that fee kind of makes up for it right there. It almost equals out, or it's probably better, actually.
Right. And for people wanting to get into the property management business, I mean, it seems like there's less fees, but it also is a lot more manageable from that business perspective, because everything is right there. Everything is more cookie cutter, whereas single family homes, again, I gave you a lot of credit, Dan. Like, that stuff is confusing. It's always unique.
Yeah, we did. We closed 109 deals this year so far that we bought and resold at a profit, rehabbing, etc. And sometimes you're right. I mean, I look at the board right now, and there's at least 85, 90 deals here at some various stage. And I do feel like I know I'm working 100 plus hours a week. It's never a chance to pull the plug, at all. I love it. I love my own obsessive compulsive nature, directed toward my company, toward my podcast, toward real estate. There's not anything I can think of that I'd rather be doing, but you're right about the level of confusion and detail and granular differences in so many different markets and areas and neighborhoods, et cetera, which brings me to, you are in how many markets right now, Lane? Maybe name them.
Ooh. Yeah, why don't we name them? Dallas, Houston. I'm not too much in Texas. I mean, Texas is just way too overheated these days. I mean, yeah, it probably was like the epicenter of this apartment boom from 2012 to 2015. But yeah, I'm not looking unless you want to bang your head against the wall and compete with all these other apartment investors, I wouldn't look in Dallas or Texas. So I'm starting Atlanta, Oklahoma City, Des Moines, Iowa, Gulfport, Mississippi, like Charles, Louisiana. Those are two examples of great tertiary markets that are emerging markets. That's really off the top of my head where they're all at. Oh, Huntsville. Yeah, Huntsville, Alabama. That's another one I really like. Great tertiary market with a big white collar workforce.
How long have you been working on putting that together? Has this been, 3, 4, 5 years? How long has this been in the works for you, Lane?
Yeah, I would say a few years. It took me a while to kind of get into it because it definitely is a reboot from single family homes. None of really the networks or the people you've met when I was doing my single family home turnkey rental days helps. It's just totally different players. But yeah, it is a very, very different game. And I was going to say earlier, I think it's kind of cool what you do because I think at the end of the day, money aside, like, when you're flipping your houses, you can make a lot of money doing that. It's kind of like hunting. I mean, it's kind of gold when you can buy a property for 50 and sell it for 150 or 200, right? For me, we don't really have that. It's a lot more like going for a bunch of singles in baseball. I mean, it's kind of lower risk, lower return. I think I really get off when, we perform $100 rent increases and maybe we're getting $125, $150 per unit. I mean, that's a lot of money in our pocket at the end of the day. But, that's how I'm kind of geeking out on, the numbers. It's a lot more finite, but because it's, times 100 units, the returns are nice.
Yeah, that definitely makes sense. I think I notice it with my small portfolio, and I'm liking that same bump in the rents. I don't care if it's $50 on a tenant that's been there a while. I don't care if it's $100. I'm just satisfied to feel as though I am moving my investment. I'm having some impact in my investment by the way that I'm, doing these little negotiations along the way. So like if I own, I don't know, it's a block of stock that's producing 2.5 or 3% a dividend, there's nothing I can do to like boost or actively try to change the performance of the stock within the market. And yet here you and I are, by watching the details, paying attention to the market, perhaps, pushing my property manager to make the rent increases and paying attention to these things instead of sticking my head in the sand. And here we are we're forcing our investments to perform better. And maybe along the way, I'm doing work on units and raising rents the same way that you are when I'm talking about my little portfolio. But I still recognize that satisfaction that you just described in the rent raises. And it's like, $100 is $1,200 a year. I would be jumping up and down and happy if I got the $100 across all 25, 30 units or however many I have right now. It would still be pretty cool, but man, over a few hundred or a few thousand, it totally makes sense where the value is coming from. What is the exit strategy, Lane? Who's buying these properties when you get to your finish line 3, 4, 5, 7, 8 years from now? Do you guys have an identified targeted audience or somebody in mind who would be the avatar for your exit at that point?
Yeah, there's a couple of exit strategies. Like the first one is, we just refinance and we pull out our equity with a supplemental loan, or just refinance it into a new 8 to 12 year note. And then we cash flow. But, ideally we'd like to get rid of these properties because they're a little bit older. They're 1980s, 1970s, 1960s properties. And we would like to exit before they get, just old crappy properties. So we'd like to sell to more of an institutional buyer, and there's a sucker born every moment. They want to buy these stabilized apartments. But the way we see it is once we've increased the value of, the property, which is increasing the rents, really there's only one place for that thing to go, which is to sell it. Just like when, you rehab a property, you make it pretty, there's really no point of holding that thing. You just sell it to some other sucker out there.
Yeah, and I mean, sometimes I'm the sucker, right? So, like, when I bought that 10-unit building, I had a new revelation of how the marketplace operates, which I never had before. 1,000+ deals, close to 2,000 deals, and I never really had the experience I had on that one. I flipped this property, had a lot of expenses. I was keeping it as a rental. And there was a gain, almost six-figure gain that potentially would have come due if I sold it. And so I did a 1031 exchange from a single-family house into the 10-unit building. And the 10-unit building was 100% physical occupancy, 80% economic occupancy. I just found out here 3 or 4 months after owning the property, to your point. But I got into that one. I guess I was the sucker for that lady. I took her hot potato. I don't think she intended on selling the property right away. She probably would have hung on to it, but we ended up like cold calling her out of the blue, and she just decided to sell. And she never raised the rents, and there's a little bit of CapEx involved in that. But I am at a price where I think I'll have a multiple six-figure gain if I turn around and sell that after it's a little bit more stable. And I feel like after I do the work, after you do the work, Lane, on whatever size, multifamily, single family, whatever the investment is, if I've prepared this investment and I've paid attention to the $50 and $100 rent increases, and I've gotten the shady characters out of the property, and I've done the $40,000 roof and improved a few units, installed central air in most of the units as they go over, and I've gotten these increases in rents, I don't know that next person who's doing the same thing that I did, 1031ing out of something he's selling for $400,000 or $500,000, and he's got a $250,000 gain, and he's doing a 1031, and he's buying my asset for $1.1 million. I don't even know if he's a sucker. I've done the hard work, and I've provided a really solid, safe, well-maintained, and improved investment that might be a little older than when I bought it, but it sort of feels like it's a good deal for him. And then if I have to 1031 out of mine and I'm sitting on a $400,000 gain, I don't want to pay. I don't even know what it is, $140,000 in taxes or whatever when I sell it at the capital gains. So I'm 1031ing with my $400,000 down payment. Maybe I'm going to put more money into that deal again at that point, or maybe I have other properties coming out. But let's just say that my $400,000 buys 25% down, commercial financing, and now I'm buying a property at like $1.2 million or $1.6 million. Having trouble thinking of the number on the fly. But anyway, I'm buying $1.5 million property and I'm putting it down and not paying any taxes. And I'd be happy to pay like almost a market price for a property in the right location that was well maintained, that I'm not going to have to do evictions and I'm not going to have to do these like extensive turnovers because maybe the building was already renovated. And so like all of a sudden the 1031 that I went through opened up my eyes to like where potentially some of these buyers are who are like, I'm a motivated buyer. When I have a 1031 in escrow, I have 90 days, 6 months to get this whole thing done. So like all of a sudden I'm more inclined to pay more for a property than I might have had to pay if I were going to go raise that $400,000 and bring in equity partners who are expecting 10, 12, 14% returns. I have to be much more selective when I have their money on the line than when I'm trying to bury my gain on the $400,000. Does that make sense?
Yeah. I mean, so I think that's the key difference is like a lot of my folks, they're more passive investors. I mean, what you're doing is great, but it takes a lot of time. It's more active. A lot of these guys, they'll go into deals and they don't want to put more than 5% of their net worth into any one deal. I mean, I don't do that today. I always sort of diversify over, multiple deals. And I don't like the 1031 exchange. And, with bonus depreciation on these larger buildings, I'm probably not going to pay taxes for the next few years, because we can do these cost segregations, pay $10,000 for an engineer to go out there, itemize the whole building. And, that's just not, you can't do that on a smaller building. It's not cost effective. But on these bigger buildings, you can do that cost segregation and you can get a huge year one bonus depreciation, which makes the 1031 totally obsolete, in my opinion.
Well, what happens when you sell the building, though? Don't you have to reclaim all that?
Right. So the analogy is you have to be like a heroin addict and you have to go into another deal the same year. And then you get that nice bonus depreciation on the next deal, which wipes out your taxable gain on this one.
Oh, gotcha. So as opposed to like you 1031ing with that entire partnership into the next deal?
Right, right. Because the downside of the 1031s is, again, like you've got a huge chunk of your money into one project. Again, you know, most of my investors, they don't go to any one deal at any more than 5% of their net worth as a general rule. And when you're doing 1031 exchanges, everybody knows it. I mean, I've known a lot of people who do 1031 exchanges or TICs, tenant in common deals, and they know they're getting gouged. Everybody knows that they're distressed buyers, and they're typically paying 105, 110% of what they should be paying.
Gotcha. Yeah, I'm spoiled. I am a spoiled individual when it comes to investments because of the number of deals that flows across my plate. And I can see the benefit of having a place to just park, you know, $50,000 or $100,000 passively and not having to do the sifting that I'm sure you and I both do as we're looking for these deals. You touched on something I think is really huge. I think it's recent from a little bit that I know about it, but the bonus depreciation. Let's dive into an example. Let's pretend I am going to invest $50,000 in one of the equity partnerships. Can you describe for me and everybody listening how that would benefit me to do this year one depreciation so that I and everyone can understand it?
Yeah, so this, you know, with the new tax laws, you're able to write off probably almost a third of the building value in year one. You know, that's what we call bonus depreciation. So, you know, most people don't care. They're like, well, how does that impact me? So let's just say, you know, instead of your 50,000, let's say you invest 100 grand just to make numbers easier. I'm seeing K1s coming back from investors this past year in 2018 for anywhere from like $60,000 to $85,000 typically of depreciation. So almost 60 to 85% of what people are putting in, they're getting back. And, you know, mind you, these are leveraged deals, 70, 80% LTV. So that's why it's so big. So that say it's like, you know, $80,000 of bonus depreciation that comes on your K1, and that offsets definitely all the gains that you got that year for that deal. But you can also bring that to your personal side because it's a flow down, and it can be used to offset your active income if you're a real estate professional, or for a lot of my poor doctors out there, it'll go into your passive loss bucket and it'll carry forward indefinitely. So maybe when you do sell a passive investment, you can empty out that bucket and use it. But I always, you know, it's always a game with my investors. We're trying to find a way to check that box on our taxes of being a real estate professional. So there's a lot of ideas such as having your spouse be a pseudo real estate agent, or, you know, you quitting your job, going to part-time to get that designation.
So essentially, let's just say for the simple numbers, I earned $100,000 in my active professional real estate business, which is true for me and a lot of people listening, and I invest that total $100,000 in the deal. I'm essentially getting a tax write-off of $80,000 that I can take, you know, in that same year. So I'm really only having to pay taxes on $20,000 that I invested in the deal, yet my whole 100 is sitting there producing a return. Do I have that right?
Yeah, that's essentially right. I mean, of course, I'm not a CPA or a tax lawyer, but, you know, you can work with your CPA and figure this out. But, you know, you wouldn't want to do that, right? You're already in a lower tax bracket. What this comes into play are a lot of like these higher net worth, higher income guys who maybe their AGI or adjusted gross income is 400,000. So now we're trying to game their way under 300,000, because when you go over 300,000, that's when you're in that 32% tax bracket, as opposed to like I think that's 24%. So what we're trying to do is you're trying to get that $100,000 of deductions to lower that AGI just a tad under 300. So those are some of like the strategic games you're trying to play. If you're a $100,000 active income, I mean, you're already in a lower tax bracket as it is. I would probably just bank those passive losses in the future to when you actually sell an asset. But that's kind of where the strategy comes into play.
Gotcha. Yeah, it's very interesting. New tax code. Who knows if that will survive the current administration or not? But I'm sure the 1031 would if it didn't, which might help someday in the future. But all that aside, cool, man. I got a ton of great information here. Let me ask you this question. Lane, if you could go back to like April 2018, 1,000+ units back, right, in time, and share the crown jewel of wisdom with yourself a year and a half ago, what would that be?
Just try and network with other passive investors and not syndicators or active investors. It's really where you build relationships with people just like you, and that's where the magic happens. And it doesn't take that many people to do it. You just have to find the right ones. But this whole thing, there's no book on this stuff, and the game changes so quickly. Like how we're just discussing this passive loss bucket strategy. Things change, and you're going to need the social capital around you to be able to move with the other more sophisticated investors.
That makes sense. Where, because I've had that experience too, where I'm at networking with the other syndicators and everybody's trying to raise money off everyone else. Where are the passive investors out there networking, Lane?
Well, they're not at your local RIA, because that's just a bunch of broke people. And they're not rolling on some internet forum, because, high net worth individuals, they typically have a job which pays them over $100,000. So they're usually pretty busy at that job, and they're higher quality folks. Not to say that, if your net worth is lower, you're not high quality, but they've got families. Somebody has chosen to marry them. They may have kids, which takes up a lot of time. So they're not going out to the bar or all these networking events all the time. So it's really hard. I mean, the best way that I've done it is, do a podcast. My Simple Passive Cash Flow podcast has attracted so many passive investors to me. And that's kind of my secret sauce. But, I would say look in your network for that rich person that are investing in these sort of country club deals. Take them out to dinner. Take them out to lunch. Figure out what they're doing.
Cool. Any good book recommendations as of late, Lane?
I'm not a big book fan. I think people read too much books. I would say just analyze a lot of properties and spend the time talking with people.
All right. Good advice. Well, hey, Lane, we're at the top of our episode here. I appreciate you shutting the door and blocking out the distractions and sharing of your wisdom today. Thanks for coming on the show.
Yeah, thanks for having me, Dan.
And thank you for tuning in to this episode of the REI Diamond Show. Keep an eye out for the next episode. Anna Barsky of 1031 IPX joins us on the show to discuss 1031 strategies for deferring gains as you increase size and scope of your real estate investments. I recently completed my first 1031 exchange, which was handled by Anna, and that deal closed successfully. During that exchange, early on especially, it was tough for me to find the correct answers for how the exchange worked, what I could and couldn't do from my accountant and multiple attorneys. When I was referred to Anna, she helped guide my transaction along with all of my what-if scenarios quickly and correctly. So on this upcoming episode, you'll get to see exactly what I'm talking about. So keep an eye out. Now, are you interested in pre-release of the next episode? That is, before the email goes out. When you subscribe on YouTube or one of the podcasting apps, including iTunes, Google Play, and Stitcher, you'll receive advance notification as soon as the episodes are published, as opposed to Saturday when I send out the email. If you prefer the email, you can head over to reidiamonds.com and sign up. Attention deal makers. I am buying houses. I am buying apartment complex deals in Atlanta, Chicago, Philadelphia, and Florida. So if you have a deal, please contact me directly using the form at reidiamonds.com or just reply to one of my emails, which I personally check and reply to. Are you an accredited investor? Interested in short-term passive mortgage investment opportunities with double-digit returns? Head over to fundrehabdeals.com to check out available high-yield investment opportunities. That concludes this episode. Thank you again for tuning in to the REI Diamond Show. Dan Breslin here. Catch you on the next one.
Thank you for listening to this episode of the REI Diamonds Show with Dan Breslin. To receive email notifications of new weekly episodes, sign up at www.reidiamonds.com.